The biggest bubble in history is about to pop, so if you want to prepare your portfolio, stay with me. Because this bubble is bigger than people realize. Bigger than 2000, bigger than 2008, even bigger than 1929. So did you know that last month there was 1.53 trillion of borrowed money riding on American stocks? This is called the margin debt bomb, and it is the highest one ever recorded, and it's growing at a speed that we've only seen 3 times in the last 100 years. Every time a crash followed within months. So it doesn't matter if you got $500 sat in an index fund or your whole pension is sat in the stock market. You're standing in the blast radius, and when this blows, investors are going to get wiped out. But a small group who understand the pattern will end up buying at the best prices of the decade. By the end of this video, you'll be in that small group. So look, I'm not asking you to buy anything, sell anything, or like anything. Just give me the next 15 minutes or so, and I'll prepare your portfolio for what's coming. So let's start with the $1.53 trillion margin debt bomb. So margin debt decides how crashes happen and how bad they get. So let me explain them properly from zero. When I explain this, you might be thinking, well, I don't use margin, so this doesn't affect me. But margin can kill your portfolio even if you don't use it. So keep listening. So what even is margin? To explain margin, I need to explain leverage first. When you open a brokerage account, the broker offers to lend you money to buy more stocks. It's usually expressed as a ratio of 2 to 1 or 4 to 1. Using 2 to 1 as an example, for every $1 of a stock you buy, they lend you an extra $1. So you end up with $2 worth of stocks. So if you put in 10K, you can now buy 20K worth of stock. Amazing, right? Well, it kind of is, because if you're holding 20K worth of a stock and the market shoots up 30%, you've made 6K. With just $10,000 of your own money down, that's a 60% return. You're a bloody genius. Until you run it in reverse. Now the market drops 30% and your 20K becomes 14K, but the loan you took is still 10K though. So in reality, your equity is only 4K now. You're down 60% of your own money. And you know, that's kind of fair really. Leverage doubles it both ways. Market goes up 30%, you make 60%. It goes down 30%, you lose 60%. Here's where it stops being fair though. Margin requirements. So the broker cannot risk losing its own money. So what they do is they set a minimum threshold of how much of your money has to be in the account as a buffer. Often this is about 35%. So keeping on with the same example we've been using, there's $14,000 left in your account. 35% of 14,000 is 4,900. Your margin requirement is 4,900. But your equity is only 4,000 because 10,000 belongs to the broker. You're under your margin requirement, boom, you get a margin call. The broker liquidates your trades, selling your stock and confirming your loss, locking it in. Who cares though? That's just a $14,000 position sold. You don't use margin, it doesn't matter. Except there's 1.53 trillion of leverage propping up the entire market right now. And you might be thinking, but who's actually mad enough to trade like this? More people than at any point in history. I call these guys 2x Chads. Chad is a bloke who's maxed out on borrowed money because stocks go up only, and he's up 60% and he won't let anyone forget it. But the trades he's making are screwing you over. They're screwing me over. Let me explain how. Because a margin call doesn't just hurt the Chad who took the loan. It hurts you and me too. So when a margin call happens, the broker is literally selling the stock in Chad's account, which pushes the share price down. And as price drops, the next guy down the line gets a margin call. This is called a margin cascade. One forced liquidation causes 2, which causes 4, which causes 8, 16, 32. On and on until everyone gets liquidated and you've got a brutal market crash. Nobody even has to start panic selling because it's all automated. And this is how it screws you. You didn't borrow a penny, but your stocks crash anyway. And this is how Chad's leverage shenanigans become your problem. By the way, if you're finding this valuable, hit the subscribe button. This is a new channel. I'll be dropping more and more content just like this. So if you don't want to miss it, hit the subscribe button. Okay, so now let me show you what happens every time the borrowing gets this heavy. These crazy leverage bubbles have blown up 6 times in modern history. 1929, 1987, 1998, 2000, 2007, and 2021. But today, I want to focus on the 3 key ones. 1929, before the Great Depression, 2000, before the dot-com bubble, and 2007, just before the Great Financial Crisis. Because understanding these will help us understand what our portfolio is faced with today so we can be prepared. 1929 first. So in the 1920s, you could buy stock with 10 to 1 leverage. So you put down $10 and you control a $100 position size. Shit was crazy back then. And of course, ordinary people did this in enormous numbers. Clerks, teachers, taxi drivers, all buying stocks with money that they didn't have because stocks were going up only. By October of 1929, brokers had lent out over $8.5 billion against stocks. That was more than all the physical cash circulating in America at the time. $8.5 billion in margin debt in 1929 is absolutely bonkers. Then the market wobbled. It started on the first day, the margin calls began, just a trickle at first. People said, it'll be fine, it's just a blip. And for a couple of days, it looked like they were right. But then Monday came and it got even worse. But people still said, no, don't worry, it's going to recover. Then Tuesday came. And that is still the most famous single day in stock market history, Black Tuesday. Hundreds of thousands of people were wiped out in a single day. And not only did they lose all of their own money, they ended up owing their broker money too. Remember that 35% buffer we talked about, the margin requirement? That's there so the broker has room to sell you out before you lose their money. But if the market crashes too fast, they might not be able to close you out in time. Then you're not just losing your money, you're losing their money, and they come after you for it. It's rare these days because computers close positions immediately, but it's still in every broker's contract that you sign. And in 1929, there were no computers. And it also can happen today. Just to be clear, you can end up owing the broker money if the market crashes fast enough. Anyway, so the market fell 89% in 1929. From its peak, it took 25 years to recover, which is absolutely insane. The next big one was the year 2000. In the year running up to March of 2000, margin debt nearly doubled from 150 billion to 280 billion. Keep in mind that we're at 1.53 trillion today. And while inflation accounts for some of that, today's bubble is still much, much bigger. But yeah, in March of the year 2000, margin debt peaked at the same time as the market and everything collapsed together. Now, everyone remembers the dot-com bubble as a story about silly internet companies, but underneath it was the same forced selling as 1929. A margin cascade that turned what could have been a tiny little correction into a major collapse. The Nasdaq went on to lose 78% and it took 15 years to recover. Now, let's quickly talk about 2007. Margin debt surged in 2006, topped out at 381 billion in July of 2007, 3 months before the S&P 500 topped and then crashed. The S&P fell 57% and took just under 5 years to recover from its bottom. There's also 2021, which led to 2022's bear market, but I've explained enough of these now. You get the picture. Let's talk about how to spot when the margin debt bomb is about to explode. There are 3 key signs and all of them are free for you to check. Sign number 1 takes you about 30 minutes a month, so there's absolutely no excuse not to do it. You track the total margin debt on the FINRA website. There's a link to it below. Here's how it works. April 2026, margin debt hit 1.3 trillion, a new all-time high. By May, it was 1.4 trillion, another record. Then by June, 1.5 trillion, a third record in a row. So, that was me tracking it. I was looking at all these numbers. But why do we track it? Because every margin debt cycle so far has ended the same way. Margin debt flies up, peaks, turns around, and then within a few weeks to 3 months, the market collapses. So the record highs we're seeing aren't great. But what's more worrying is when it peaks and turns around. If next month it goes from 1.5 trillion back down to 1.4 trillion, that's when I'd start to worry. Sign 2 is the speed at which it's growing. Margin debt is up 51.5% in the last year. In the whole history of the data, growth above 50% has shown up exactly 3 times before March of 2000, July of 2007, and March of 2021. You know what happened after each of those because, we've just talked about it. In the year 2000 specifically, the year-on-year growth peaked at about 80%. So alongside watching for a peak in the total number, a slowdown in acceleration is also worrying. Now, I know this is counterintuitive because I keep telling you that the 1.5 trillion margin debt bomb is a bad thing. So why would I want it to keep growing? Because as long as it keeps growing, there's still borrowing happening and there's still buying happening. It's when it stops that the cascade is starting. So that's what you have to watch out for. Now, sign number 3 is when the brokers themselves get nervous, which is pretty worrying as far as a sign goes. Since the brokers are the ones handing out the loans, they know better than anyone when the bomb is about to blow. And when it is, they need to protect themselves so they don't lose their money. Because the bomb blowing usually comes in the form of a massive crash and they don't want to lose their money. So what do? Well, remember margin requirements, the buffer that they force borrowers to keep in their account to protect against the crash? They simply raise the margin requirement. I said that it's usually 35%, they raise it. We got a small preview of this in January of 2021 when the meme stock chaos got out of hand and brokers not only upped margin requirements, I mean, they just cancelled leverage entirely overnight at one point. And we saw it in silver last year when COMEX kept hiking margin requirements and then the price of silver fell around 50% over the following months. You see, the brokers learned their lesson in 1921, so now they raise margin requirements when things get too overheated. And when you see those headlines on, the Financial Times, Reuters, Bloomberg, whoever, that's them heading for the door while telling everyone else that it's fine. So there are your three: the total peaks, the acceleration stalls, and the brokers start tightening. See all three of these lining up together and you're not early anymore. So now that you know how to spot margin debt peaking, let's talk about what actually happens when it does peak. I think that when this debt bomb blows, it'll be worse than 2000 and worse than 2008, maybe even worse than 1929. And I'll walk you through why. So in the year 2000, the peak was 278 billion, and the 2007 peak was 381 billion. Today, it's 1.53 trillion. That's roughly 4% of the entire US economy, a bigger share than either of those previous peaks. The selling is also faster now. 2008 unwound over months of humans making phone calls. Today, leveraged money gets liquidated by machines inside of an afternoon. It's just instant. And the market underneath it is more crowded than it was back then. We all know how overheated the AI trade is. I mean, 10 stocks now make up 43% of the S&P 500's market cap. And this whole bubble is propped up by this 1.53 trillion that I keep talking about. So when we combine all of these factors, I truly believe that when this margin debt bubble pops, it will be worse than 1929, 2000, 2008. I've already said that a million times. Now, look, this doesn't mean that there'll be another Great Depression or a massive recession that lasts for decades. That's not what I'm saying. Although it can happen, we can't rule it out completely. But what it does mean is that on the low end, we could see a drop of, 50% on the S&P. On the high end, 70 to 80% is on the table. But you see, this should excite you if you know what you're doing. It shouldn't really be scary. I mean, I love the idea of a 70 to 80% crash, because it's going to give me an opportunity to buy stocks very, very cheap. Now, we need to talk about how you end up in the group that's buying and not the group that's being absolutely liquidated. But first, let me argue against myself a bit, because I'm not here to just give you one side of the story. I want to talk about what if I'm wrong. So there are a few things that say that this might not be as bad as I think it is, and we should really consider this before we plan for how to protect ourselves, because we have to understand the best and the worst case scenario. That's how investors think. They consider the best and worst case, and then they make a plan around those. You don't plan just for the best case, because that's dumb. You don't plan just for the worst case, because then you're never going to make any money. So let's look at the best case scenario, because we looked at the worst. So there's a measure where this whole thing looks a little bit less scary. When you look at the margin debt as a share of the entire stock market's value, that way margin debt is about 2.2% right now, and the 2000 top was 2.3%, in 2007 it was 3%. So relative to how big the market has actually become, the borrowing isn't at record levels yet, and that's a fair counter argument. It might mean that there's still room left to run before this thing actually peaks. But that's also scary, because the bigger this pile gets, the more violent the forced selling will get. So, it's not necessarily a good thing. Second thing, there's no real timer on this. The borrowing peaks, then the market tops. But we can't know when the borrowing actually peaks. It could be this month, it could be next month, it could be a year from now. We don't know for sure. But this is why you'll never catch me saying that the market is for sure going to crash on a certain date, or that I'm selling everything, because I'm not. Trying to time the market is an all-in Chad kind of move. That's not us. What we're doing is we're recognizing the danger, looking at the best case, the worst case, and creating a plan. Now, the third thing is that the last time this fired in 2021, the aftermath was a 25% bear market. I mean, a 25% drop is harsh, but it is survivable. It's nothing too serious these days. And maybe that's all that's going to happen this time when it pops next. Totally plausible. I think it's going to be worse, but maybe I'm being an alarmist. What do you think? Let me know. Now, I said that when this peaks, I expect the S&P to drop anywhere between 50% and 80%. And I still believe that, because I think this one is structurally different to 2021. But I just want you to keep in mind that I could be wrong, and that it might be much smaller of a crash than I predict, and that's completely fine. You can be wrong and still make money as long as you're prepared, which is what we're going to finally talk about right now. How do you actually end up in the group that's buying instead of the group that's getting sold, that's getting liquidated? Three things, and all three have to be done before it happens, because nobody makes good decisions, in the middle of something like this. So you need to prepare. So one, don't be a forced seller. In every crash on this list, the people who got destroyed first were the ones who owed someone money, the ones who were trading with borrowed money. If you don't owe anyone anything, they cannot make you sell the bottom. That's the whole defense. That's it. To be fair, I do leverage trade sometimes, but literally just for fun. I've been a trader for 25 years and I never do it with money I can't afford to lose. It's just play money. But if you don't have experience, do not leverage trade. I quit trading a while ago to focus more on investing. Should I do a video on why I quit trading, by the way? Let me know. Anyway, number 2, have something to buy with. Right now, I'm holding more cash than usual. It's parked in short-term treasury bills, ETFs collecting about 4% while I wait. Boring? Yeah. But that's exactly the point. Now look, I need to be clear about something here because I'm not a fan of treasury bills and I've made that clear on my videos in the past. And 4% doesn't beat inflation. I'm also not a big fan of holding cash, but as a short-term measure, because I'm waiting to snap up some stocks, gold and silver at cheaper prices, holding cash is okay. It's just a tool for me. That's just my opinion though. I'm not telling you to go and sell your stocks. That way you have cash to buy a crash that might not come for a year or two, but just monitor the signs we talked about. And if you personally feel like things are overheated and you've got some big winning positions, trimming some of them, taking profit so you have a little bit of cash on the side is never really a bad move. Okay, number 3, and this is the one that almost nobody does. Write your shopping list now. Everyone says that they'll buy the dip, but almost nobody actually does because when it's happening, it doesn't feel like a dip. It feels like the end of the world. The headlines are horrendous. Your portfolio is red. Your mate's telling you that it's going to keep going down, so don't buy yet. And buying just feels absolutely insane. So you take the decision away from the you that's going to be panicking and you give it to you today, the calm you. Today, write down 5 companies you genuinely want to own for 10 years. Then write down the price you'd be happy to pay for each one. Not a prediction of where price is going to drop, just the price that you would be happy to pay for each of these companies. I'll give you a crazy example. I'm not a fan of SpaceX. I think it's a bit dodgy, but you know, SpaceX at $80, I might buy it. We'll see what happens. Maybe below $80. We'll see. If it gets that low, I might buy it. Anyway, if you want me to do a full video on my list, what I'm planning to buy and where, let me know. I'll see you in the next one.